In today's episode, Alex asks the very interesting non-marketing question, why is the banking system such a hot mess? Why don't we just deposit and withdraw directly from the U.S. Treasury? Okay, this is a complicated question, an extremely complicated question. The banking system as it is today is relatively stable compared to how it's been over the last few centuries. Originally, banks were purely private enterprises. There was no such thing as the FDIC, the Federal Deposit Insurance Corporation. There was no such thing as, regulations like Dodd-Frank. And as a result, banks were incredibly dangerous places to store your money. If your local bank got robbed, everybody, by train robbers or whatever, all the depositors lost their money at that bank. There is a reason why, robbing a bank was the easiest way to get money illicitly for a long period of time. What has happened, banking as an industry has always tried to figure out ways to be profitable. If you are a purely depository institution, meaning people just go there to save money, to store money, you don't make much money, right? It's not very profitable to just hold on to other people's money until they need it. Where the money is made in banking is on the investing side, issuing loans, right? Letting someone borrow money for a mortgage or whatever, and they pay it back with a certain amount of interest. Investing in equities, in all sorts of stuff, heck, in Bitcoin, whatever. That's how banks make their money. They take the money that they have and they reinvest it. The reason why the banking system keeps getting into all kinds of trouble is because this is fundamentally commingling of two things that shouldn't be mixed. Give this some thought. Suppose that you stored all your money in a jar, right? Which is a terrible idea. But let's say you stored all your money in a jar, your rent and all that stuff. And let's say you were also an avid casino gambler. Is it a smart idea to put your rent money, your food money, and your casino gambling money all in the same jar? No, it really isn't. It's a really bad idea. You should partition that, keep it separate. Say, this is as much I'm willing to risk at the casino this week. The rest of this money is set aside, for specific purposes. Banking has found itself in trouble many times over the years because they don't do that, right? Banks, even just with basic lending, are essentially taking the money that depositors have given them and giving it to other people with the expectation that those other people would pay that money back with interest, right? That, again, this is how banks make money. The challenge is you can only loan a dollar or any currency a certain number of times before it gets dangerous, right? If I have $10 or 10 euros or 10 pounds or whatever, and I put that in the bank, my expectation as a consumer is I can go to the bank anytime and pull out my $10, right? And for the most part, that's true. Except when everybody at the bank says they want their $10. Why is that a problem? Because banks don't hold on to all the money they're given, right? They lend it out. There are regulations, at least in the USA, and certainly all around the world in other banking systems, which say that banks may not lend out more than a certain amount of their deposits, right? A certain amount of their money. And in the United States, banks are required to have, I believe, 10% of the total deposits available at any given time, so that somebody comes and says they want their $1 million, you can give them their $1 million, right? And that's how bank runs happen. When a bank has lent out so much of the deposits that it no longer has them, right? No longer that money's physically not in the building anymore, which means that the bank can't give you that money. It's simply not there. Now, again, this might or might not be, a showstopper if it weren't for the fact that the concept of what this is called fractional reserve lending. And that 10% requirement in the USA means that banks can loan out that same money over and over and over again to different people as long as they maintain 10% of their total deposits on hand. Think about what that means. If I'm a bank and I have $10 of yours, I can loan Bob $10. I can loan Sue $10. I can loan Tamika $10. I can loan Jerry $10. And as long as they all make their payments, they pay $1 a month for 10 months, things are good. I've got money coming in to replace what I've lent out, and it's coming in with interest, so I'm making money. If Bob can't pay his bill anymore, that $10 is gone, right? Because the loan goes bad, and you do as much as you can to recover it, but at some point you have to write it off and say, like, yeah, we're just not getting that $10 back from Bob. If that happens enough, you wipe out your deposits because you don't have that money anymore. And so that's how the banking system manages to get itself in trouble an awful lot. Now, what the banking system has been lobbying to do, and thankfully the folks who are in power have thus far been smart enough not to do it, is essentially want guarantees on the deposits so that they don't have to hold on to that money. They can lend it, willy-nilly and face no consequences if the loan goes bad because the government will underwrite it. And the government will say, well, we'll show up with a bag of money and bail out everybody. This is kind of what happened in 2008 during the Great Recession. In 2023, a similar smaller program is happening, but at a much more reduced scale and a much more smartly run program where depositors are saying, the government tells depositors, yes, we will make you whole. We will guarantee your deposits, but we'll let the bank fail. We'll absolutely let the bank go out of business. All the investors on the gambling side, because all investments are gambles, they're going to lose all their money, right? They lose it all. And that's as it should be because investments are not guaranteed. Investments are a gamble. The way to fix this, to prevent this from happening more, is to continue to segregate, to push banks to have their deposits on hand and to not use that money to go gambling with, right? In the same way that if you're trying to get your house's finances in order, you would tell, yourself, okay, I'm going to set this money aside for gambling and I'm not going to touch any of the important money that I'm going to need for later on. The likelihood of this happening is very low because banks are for-profit institutions. They are very, very, very well funded, and they spend a lot of money on lobbying politicians. They have been trying to overturn key provisions of a series of laws, including the Dodd-Frank law, for years now, ever since the law was passed, because it makes it harder for banks to make money. It makes it harder for them to be profitable because of things like fractional reserve lending limits and saying, hey, you have to have 10% of your deposits on hand. Before the Great Recession, that percentage used to be much lower. At some banks, it was down to 1%. And of course, those big banks imploded, and the government did bail a good number of them out. So that's why the banking system is such a hot mess. And the way to constrain it and reduce those risks is more regulation, which is never you never want more regulation if you can avoid it because it's just extra overhead. It makes things more complicated. Generally speaking, you try to let the market work for itself, but there are cases where you have groups or people or industry sectors that are just so profit driven, so greedy that they will behave irresponsibly and harm their own long-term interests, but in doing so also harm a whole bunch of people, right? I have no problem with companies wanting to make money. My company wants to make money, right? Your company wants to make money. There's nothing wrong with that. There's nothing wrong with being profitable and earning good money. There is a problem when your gambles don't pay off and you are gambling with other people's money that they did not give you permission to gamble with. That's where the problem is. Right. So again, anything that can be done to separate out the deposit section of banking from the investment section, keep the safe money from the unsafe gambling, it's going to be a good thing. Anything trying to weaken that wall, but that very thin wall that exists right now, is generally a bad thing, right? Because this is a sector that generally can't be trusted, which is ironic, since we give them our money to hold on to it. Anyway, that's a very long answer to a very complicated question, and we still have not touched on most of the major issues because, well, that could take days. But it's a very good question. It's an important question. It's worth discussing. Get to know finance law, and wherever it is you're based, whatever your jurisdiction is, whether it's a country in Africa, a country in Asia, a country in North America, learn the laws of what corporations are and are not allowed to do specific to banking. You will be surprised at just how many loopholes there already are, and how many people are trying to take advantage of them. Thanks for tuning in. We'll talk to you soon. If you like this video, go ahead and hit that subscribe button.